If you've been looking to invest for a while, then you must have heard the terms 401k and Roth 401k. Now, both of these are popular tax advantage retirement savings options and are amazing options for those of you looking for a more passive form of investing. Hey, and welcome back to the channel. Today we're going to highlight the differences between the different kinds of 401ks for you. So let us begin. So let's start with the 401k. A 401k is an employer-sponsored retirement savings and investment plan. Employees who contribute to a 401k plan receive a tax credit on their contributions. Employee contributions are deducted automatically from their paychecks and invested in funds selected by the employer from a list of available offerings. In 2022, the yearly contribution limit for 401ks will be $20,500 or $27,000 for individuals 50 and over. The catchy name derives from the portion of the tax code that introduced this form of plan, especially subsection 401k. Employees contribute to an individual account by having their paychecks deducted automatically. The tax reduction comes either when you contribute money or when you withdraw in retirement, depending on the type of plan you have. So we hope that you paid attention during your first day as an employee because this information is usually imparted to fresh recruits on the first day. Now that you guys know what a traditional 401k is, let us talk about the Roth 401k. The Roth 401k is a form of retirement savings plan that is offered by firms to their employees. This plan is quite similar to the standard 401k, but there is one significant distinction. Contributions to a Roth 401k plan are deducted from a worker's paycheck after taxes have already been withheld. When you contribute money to a Roth 401k, that money will grow tax-free and you'll be able to take that money out when you reach retirement age. Now listen guys, whenever you get the words tax and free in the same sentence, then that is definitely a moment to be happy about. The most beneficial aspects of both the standard 401k and the Roth IRA were incorporated into the Roth 401k, which became available to the public in 2006. Just like with the standard 401k, if your employer provides one, you'll be able to benefit from a corporate match on your contributions with the Roth 401k, provided that it's offered. In addition, the Roth 401k component of a Roth 401k offers the advantage of tax-free distributions from the account. Let's take a look at the similarities between these two investment vehicles. The first thing to note is that, as was mentioned earlier, both of them are workplace retirement savings choices. With either variety of 401k, the number of your contributions will be deducted from your paycheck on a regular basis. Who said that putting money down for retirement would be that difficult? Second, both plans often contain a contribution from the firm. About 86% of organizations that offer 401k plans to their employees also match the contributions made by their workers. If you work somewhere that provides a match, you should definitely take advantage of it. Your company is providing you with unearned compensation. Third, the maximum amount that can be contributed to either variety of 401k plans is the same. In 2022, like I mentioned earlier, the maximum annual amount that can be saved in your account will increase to $20,500 or $27,000 if you're above the age of 50. When compared to the annual contribution maximum of $6,000 for a Roth IRA, the ability to invest that much money every year is a significant advantage offered by both types of 401k plans. But this is where the similarities end. It is time for the differences now. The manner in which the money you put into a standard 401k and a Roth 401k is taxed is the primary distinction between the two. So let's begin by providing a straightforward description of taxes, and only after that will we go into the specifics of the topic at hand. Taxes are already notoriously difficult to understand and calculate, let alone pay. A Roth 401k is a retirement savings account that is funded after taxes have been deducted. That implies that taxes have already been taken out of your contributions before they are deposited into your Roth IRA. On the other hand, a standard 401k is an account saving money before taxes are deducted from it. Your contributions to a standard 401k account are deducted from your paycheck before taxes are taken out. As a result, the portion of your income that is subject to taxation is reduced. Let us put the last two statements in perspective by delving a little bit deeper into the dynamics of how these accounts work. We're going to start with contributions. Your money goes into a Roth 401k after taxes. That implies that you're paying taxes right now and getting a lower salary. Contributions to a standard 401k are tax deductible. They're deducted from your gross wages before they're taxed, lowering your overall tax payment for the year. You might be asking why anyone would pick a Roth 401k over a traditional 401k if it means they won't receive a tax break right now. If you're only considering the years you've contributed, that's a reasonable question. However, bear with us. When you start withdrawing money in retirement and in the years following that, the major benefit of a Roth kicks in. Don't believe us? Well, let us give you some perspective. Assume you have $1 million in your retirement account. That's quite a collection. Because you've already paid taxes on it, most of that $1 million are yours free and clear if you put it in a Roth 401k. Well, what if $1 million was invested in a regular 401k? In any case, you'll have to pay taxes on every dollar you take out in retirement. Depending on your tax bracket and the tax rates in effect when you retire, you could end yourself owing Uncle Sam hundreds of thousands of dollars during your golden years. It's a bitter pill to swallow, especially after you work so hard to accumulate your savings. It goes without saying that if you don't pay taxes on your withdrawals, your retirement funds will last longer. That's what sets a Roth 401k, and for that matter, a Roth IRA, apart from standard investing accounts. That's why we always advise you to take advantage of all your Roth alternatives. Finally, the last benefit between the two is how you access your money. No matter what, you are permitted to begin taking your payments from a standard 401k at the age of 59 and a half. If you have a Roth 401k, you're able to start taking money out of the account at the same age without incurring any penalties, provided that you have owned the account for at least 5 years. If you're still many years away from retiring, you have no reason to be concerned about your financial future. However, if you're getting close to the age of 59 and a half and are considering opening a Roth 401k, it is imperative that you are aware that you'll be subject to a financial penalty if you withdraw money from the account within the first 5 years of opening it. Now that you know all about the similarities and differences between the two, let's talk about when these two accounts make sense. People often recommend that individuals should contribute to a regular 401k because a Roth 401k does not have the same conversion option. This holds true especially if you have children. You may want to take the tax reduction now to help you save on taxes and increase your cash flow. Because you may be residing in a different state when you retire, you have greater flexibility over when and where you pay off your taxes with a standard 401k. If you have a period of lesser income, converting a regular 401k into a Roth individual retirement account or IRA at a lower tax rate may be a good option. Individuals who cease working before reaching full retirement age, about 66 or 67, and do not immediately begin collecting Social Security may receive a larger reduction in their tax rate. This is a good moment to convert because it will save you money on taxes. Changing your retirement address to avoid cities and states with higher income taxes is the same thing. As a result, contributing to a Roth 401k while living in New York City makes little sense unless you plan to retire in a place with a similar high tax rate. For many people, the increased flexibility of a typical 401k makes it their preferred employer-sponsored retirement plan. Now, for the Roth 401k, if you're a big saver, a Roth 401k might be a better option. When you max out a Roth 401k, you put more money into a tax-deferred account than if you max out a standard 401k. Let's imagine you contribute the maximum amount to your 401k in 2022, which is $20,500 or $27,000 if you're over 50. The $20,500 Roth 401k contribution is made with after-tax money, whereas the standard 401k contribution is made with pre-tax dollars. In this hypothetical scenario, you have $1,360,000 in your retirement account after 30 years of earning 5% yearly. Unfortunately, you must pay income taxes on your retirement money if you have a typical 401k. A typical 401k will leave you with $953,000 to spend in retirement if you pay 30% in taxes versus $1.36 million tax-free in a Roth. To have a balance of $1.36 million after taxes in a typical 401k, the pre-tax contribution would have to be $29,242. If you anticipate being in a higher tax bracket when you reach retirement age, you should also think about opening a Roth 401k account. For the sake of this illustration, let's assume that you anticipate a rise in your effective federal tax rate from 24% while you're working to 32% when you are retired. This suggests that the Roth 401k would be the preferable option since you would pay a lower tax rate, now 24%, than you would expect to pay in retirement. This is because you would be paying taxes on your retirement savings at a lower marginal rate, or 32%. Additionally, if you want to leave assets to descendants and you want those assets to be inherited tax-free by your heirs, then a Roth may be a better option for you. It makes sense to use a Roth 401k early in your career and then contribute to a standard 401k later when your wages improve for most of us who follow the normal income curve. This technique allows you to avoid the highest tax bands during your best earning years while still allowing you to withdraw money from your retirement account with ease. It can be the greatest option, particularly if you work in a high tax state and intend to retire in a low tax state. Cash flow is the most important consideration during the early years of a person's professional life or career when they're beginning a family. Salaries are often lower, daycare is expensive, first residencies come with huge mortgages, and saving for retirement and college are competing forces. People are more likely to contribute to a tax-deferred 401k in order to save money during these years and to have more spare income for life's necessities. For cash flow reasons, contributing to a typical 401k makes sense. In the end, we would like to say that everyone has a unique financial situation and different financial goals. So to get to the best deal possible, we recommend that you talk to your financial advisor on what is the best route for you. So that is all the time we have for today, folks. I hope you enjoyed this video. Don't forget to leave a like and subscribe to the channel if you haven't already. Anyways, I look forward to seeing you next week. Peace.